Meet Jane. Jane is on the road to becoming a passive investor in multifamily real estate. Jane is presented with many types of apartments to invest in, but does not know the difference between them. Jane is told by her friend Derek that just like her kids' report cards, apartment complexes are also graded. Derek explains that multifamily assets are evaluated based on their location, age, amenities, and their level of rental income. Derek tells Jane that Class A apartments represent the newest and most luxurious complexes, where the purchase price is high and the yield is low. Class B apartments are built within the last 20 years, but are not quite up to the highest standards as Class A. The purchase price is lower than Class A complexes, and yield may be slightly higher. Class C apartments are usually over 30 years old. These properties might be outdated and need some improvements. The purchase price is lower than both A and B complexes, and due to the opportunity for value add, this asset can result in a much higher yield. Lastly, Class D complexes are considered extremely run down and need major repairs. There is a low purchase price, but costs to repair Class Ds will be much higher. Derek reminds Jane that these are general guidelines, and it does not mean that there cannot be a hybrid situation. For example, a 30-year-old apartment in a prime location can still be considered Class A due to both condition and location. Jane now understands the various multifamily asset classes and is excited to get started investing.